All right, good afternoon, traders. This is your free video update from seasonalswingtrader.com. Today is Tuesday, July 11th, 2017, and today we're going to take a look at CF Industries, ticker symbol CF, traded on the NYSE, and we're looking at a seasonal play to the upside. This trade has risen higher 9 out of the last 11 years and has notched an average gain of 11.8% over those last 11 years of stock performance. So what we want to do is pull up a daily chart on CF and look at the current price action. Today we're trading at $29.25, down approximately 50 cents for the day. But you can see here on the chart, we finally broke out of multi-week congestion here. We had a small triangle breakout, which we can display by drawing a triangle here. We broke out to the upside. So all this congestion happened right around the 50% retracement level. And you can see we also got above the 50, 100, and 200-day averages. So we've got the 50-day average in blue, the orange is the 100-day average, and the 200-day average in purple. So now that we've cleared all of the averages and are staying consistently above the 50% retracement level corresponding with a seasonal move to the upside, we like this trade higher. Now, we do have earnings around August 2nd, so we want to do some type of play, either buying the outright stock or doing some type of option spread and be out before earnings. Okay, for the credit spread traders, we can look at selling some put spreads either at the money or slightly in the money. Again, we're trading at $29.25. I'm looking at the 29.5, 28.5 puts for the July weeklies. These will be the end of month July contract with approximately 17 days left till expiration. You see here, it's almost a 1-to-1 risk-reward ratio. We have 45 cents of premium brought in against a 55 cents max risk. So if we gap down below 28.5, our max risk is 55 cents or $55 per contract. If we trade and close above 29.5 at expiration, our max profit on the trade is $45 or 45 cents per contract. So feel free to play around on the option chain depending on your risk tolerance and capital. Those that like selling cash secured puts could come down here on the chain and sell out of the money puts around the 28.5 level, keeping that premium if we close above these strikes at expiration. Now, if we did close back below and we were assigned, this premium you do keep, and that goes against your cost basis. Always a good idea to go ahead and spread a little bit further down the chain just in case. But if you don't mind owning the stock at these levels, that is a good strategy and can be considered. Alternatively, if you don't want to trade options, just want to trade the stock outright, we can consider getting long here at the 29.25 level and selling a covered call against the position. All kinds of opportunities to look at here on the chain. For instance, we could sell the 29 calls, which are in the money, sell the 29 calls against our stock. So if we're trading at 29.25, we sell the 29s. If we were to get called away, we take a 25-cent loss on the position because we're long at 29.25. We sold the 29s. We take a quarter loss on the stock, but we brought in $1.18 or so per call, so that nets us about 90 to 95 cents per 100 shares if we were to get called away. There's also some pretty decent premium up here out of the money. We can buy here at $29.25, buy the stock at $29.25, sell the 29.5s at around 90 cents. You get to keep the 90 cents plus the difference between where you bought the stock and the strike. So that's 29.5 minus 29.25. So that's a quarter added to any premium you received. Same here on the 30s. We could buy the stock at 29.25, sell the 30s for 70 cents. So we keep 75 cents above 30. So we bought the stock at 29.25, get called away at 30. That's 75 cents we get to keep, plus the premium here, that's 70 cents. So it's $1.45 or $145 per 100 shares. And you can see the list goes on and on. Personally, I think a good strategy, if you can trade in multiple lots or multiple 100 lot shares, is spreading out down the chain. So buying 300 shares or so, selling 129 call at 115, maybe 129.5 call at 90 cents, and maybe 130 call at 70. So you can spread it down the chain, and all of that premium you collect goes against your cost basis in the event you were not called away. So those are a couple ideas for you in CF. Hope it helps. If you have any questions, email us at support@seasonalswingtrader.com. Feel free to take a trial using one of the links above. And follow us on YouTube, Twitter, Facebook, and Instagram, and we'll see you on the next update. Traders, like what you see, want more trade ideas each week? Take a $7 30-day complete member access trial by clicking the link below. You'll have immediate access to analysis and seasonal trade ideas on over 35 commodity and currency futures markets, as well as coverage on all of the major stocks, exchanges, and ETFs in the U.S. marketplace. If you like us, follow us on Twitter and Facebook, like us on YouTube, and we hope to see you on the inside.